Welcome back to Store University. I'm Chris Volk, CEO of Store Capital, and this is our 7th segment of what we plan to be 10 small introductory courses that are designed to help you evaluate and get the most out of your business. The subject for this 7th lesson is one that is near and dear to me personally, which is, what's the best way to finance your corporate real estate? I started my own career as a commercial banker and then migrated to long-term real estate finance solutions where I've been for the last 30 years. In my career, I've extended real estate loans, real estate leases, and permutations of both, all with an eye to creating optimal capital structure at the time for our customers. If you recall from Lesson 6, corporate financial efficiency is one of the 6 levers that business leaders have to create shareholder value. And this is where decisions like leasing real estate versus owning real estate come into play. The major goal of capital efficiency is to lower the cost of capital and thereby increase the return on shareholder equity. Store University has already spent a lot of time delving into the computation of shareholder equity returns in Lessons 2, 3, and 4. Importantly, I showed you a tool called the V formula, which is a financial computation shortcut I devised for computing equity rates of return. So in this lesson, we're going to look at the relative benefits of leasing versus owning using the V formula framework. The V formula is a highly useful way of getting to the heart of decisions and their impacts on equity returns and therefore on business values. First, let's start with some basics. Many companies employ real estate every day in their businesses. Commercial real estate can house corporate manufacturing and distribution activities, or it can house a service business such as a health club or restaurant, or it can be a retail store, or it can be an office housing your staff. Some companies use real estate more than others to conduct their businesses, and I call such companies real estate intensive businesses. As you saw from Lesson 1, which covered how to value a business, long-lived assets are best financed for a long time. Long-term financing will minimize your monthly payments, maximize your cash flows, help keep stable the equity rates of return, and thereby raise the value of your business. So what would be the ideal type of real estate financing? I would say that if possible, it would be to own your real estate using 100% financing, a low long-term fixed interest rate, a fully prepayable loan with minimal prepayment costs, a loan that's freely assumable, and a loan having no covenants restricting your corporate behavior. Now, I would tell you that such financing is not generally available as I stand here and film this lesson, but I occasionally see financing that really comes close to these parameters. Now, if you're less committed to a particular real estate location, you might look to lease a property. You would seek an optimal lease arrangement that would give you an option to vacate the location and move in the event you outgrow the property or you elect to close it. In this light, you would want a short-term lease having as many extension options as possible, preferably at a known fixed lease rate. And you would wish for the ability to assign the lease to anybody you choose in the event that you sell your company. In my career, I cannot say that I've seen such a product. Note that in the 2 examples I just gave of ideal and imaginary real estate financing solutions, there was some discussion of financial terms, including lease and interest rates, proceeds financed, and the terms of financing. But there was also some discussion of business flexibility features like assignment rights, prepayment ability, and the ability to vacate a property for a preferable location. All of these aspects of commercial real estate finance can absolutely impact the value of a business. For the purposes of much of this lesson, we'll focus first on the impact of the pure real estate finance terms on the value of your company. And then we're going to start in our next lesson to use the V formula framework as our guide. Until then, I'm Chris Volk, and thanks for joining me on this value creation journey.